Stunning earnings from two banking biggies today. Both JP Morgan and Wells Fargo reported record third quarter results and strong gains in lending. But investors didn't buy in. Both of those stocks sold off and they pulled down the broader market. Here are the numbers. JP Morgan earned $1.40 a share, 34% above last year, and well ahead of analyst estimates of $1.21. Wells Fargo reported better than expected earnings as well, 88 cents a share. That was 22% increase from the prior year. So why did the sector and the stock market sell off? Erica Miller reports.
The earnings at JP Morgan Chase and Wells Fargo may have hit record levels, but investors focused on one big negative. At $21.2 billion, revenues at Wells Fargo fell short of expectations. On a conference call today, the company's CEO John Stumpf tried to put a positive spin on the quarter.
This strong performance during a period of slow and uneven economic growth was driven by momentum across Wells Fargo's diversified businesses.
Wells Fargo is the nation's largest mortgage lender, and improvement in that business accounted for much of the earnings gain. The bank was not only able to make more new loans to consumers, it also collected more interest on its loans. But falling interest rates pressured profit margins.
The thing that stood out the most about Wells Fargo was that the net interest margin fell 25 basis points. What that means is the spread between lending and borrowing fell the most that it has fallen in years.
That wasn't just bad news for Wells Fargo shares. It added to pressure on Bank of America, Citigroup, and JP Morgan stock as well. But there were some positive industry signs in JP Morgan's results today. The nation's largest bank by assets saw improvement across all its businesses, including trading.
It was nice to see the rebound in trading and some of the things that had really been impacted earlier this year. We cannot understate how important those are to the industry and to JP Morgan Chase.
JP Morgan CEO Jamie Dimon also tried to put to rest concerns about the London whale fiasco, which racked up $6 billion in losses.
Obviously, we had a gap in the armor here. Like I say, an arrow went right through that gap. But other than that gap, we think we have pretty damn good controls and stuff like that.
Now Wall Street is waiting for reports from Citigroup, which reports before the bell Monday. Analysts believe the strong trading results at JP Morgan bode well for its rival. Erica Miller, NBR, New York.
For more on those earnings, we turn to Fred Cannon. He's the co-director of research at Keefe, Bruyette & Woods. So, Fred, is it fair to say, looking at these earnings, that banks are healthy again, that they're back to normal? I mean, what's your take on this latest round of earnings?
Certainly they're back to health. The balance sheets are solid. The kind of issues that we faced in the financial crisis are well behind us. Earning money is still tough on them, and especially the outlook in this interest rate environment. That's why investors got a little bit squeamish today, despite the strong earnings.
So it looks like housing was the theme, but what about other loans, business loans, auto loans, personal loans? What can you tell us about that?
Right. At least at these big companies, we're not seeing the kind of growth outside of mortgage that we have seen in recent quarters. And loan growth is pretty slow. And the truth is that, as a lot of people know and most viewers know, today if you really don't need a loan, if you got stellar credit, and you can get a loan pretty easily, but for many other people it's still very tough. But the net effect is that outside of mortgage, we're not seeing a lot of loan growth.
So is this going to be the theme when we get a new batch of earnings next week? We have Citi reporting on Monday, then we have Bank of America on Tuesday, also Goldman Sachs and Morgan Stanley reporting on the investment banking side. What do you think we're going to hear from those companies?
Okay, so it's the yin and yang of banking in the world of quantitative easing. On the one side, this interest rate environment's tough, the spread between deposits and loans narrowing. On the other hand, there's pretty good activity, housing's picking up, credit's getting better. So as we look at the bank earnings, we have to differentiate who's really hit by that net interest margin issue and who can benefit on the other side. We look at Citi and we think they should report a pretty good number on money, so we think that'll be positive. On the other hand, Bank of America faces a lot of these pressures from the deposit versus lending squeeze.
You told me that Citi is your top recommendation right now. Tell us why.
Well, we look at Citi, and it's a bank that has not performed as well as some of those other tough ones like Bank of America this year, on the one hand. On the other hand, we think it's a great play on what the Federal Reserve is doing. When they put all this money into the economy, they are stimulating housing. Citi has a lot of problem assets related to housing left. They're stimulating emerging markets. That's where Citi's the strongest. And they are depressing that net interest margin, but that's not a real big issue for Citi.
All right, let's take a look at some of your other picks besides Citi. You like Goldman Sachs. You've been telling us this all year long. And you also like the regional bank, SunTrust. Again, what's the attraction?
SunTrust, again, it's in the southeast. It has continued to have credit problems later than a lot of the other banks. But that's been a bad thing, but now we think it's a good thing, because right now we can still see a lot of positive improvements as we start to see a pickup in the economy and housing in places like Florida can help move that stock back up. So we still like SunTrust.
We just have about 45 seconds left. A new round of bank stress tests coming up. How do you think banks are going to do? Are they strong enough to withstand a financial downturn?
Well, I think they're strong enough. The question is, does the Fed think they're strong enough? And that's what we're going to find out. I think it's going to be a tough time period for the banks, because the stress test scenario, in other words, what they're going to be stressed for, comes out right after Thanksgiving. That's right before we go into the fiscal cliff debate in the U.S. So the Fed's going to be very concerned about that, and they're going to put out a very tough stress test on the banks. We'll see what happens, but I think we'll probably could be yet again a little bit disappointed from what we hoped for in terms of dividends and share repurchase out of the big banks.
All right, we're going to have to leave it there. Any disclosures, Fred, on the stocks that you talked about?
No, thanks. Great to be on, Susie.
Thanks. Have a great weekend. Fred Cannon of KBW.